Good afternoon, everyone. Good afternoon, everyone.
Good afternoon.
Aha! I just sent you all an email. Another case I just found.
Ms. Archer, can you send it to my personal email, please?
What's your personal? Because I only have the Bank of the Bahamas on my sheet.
Keishla_Mackey at outlook.com.
_ Marquis Outlook. Okay.
Thank you.
You're most welcome. Hold on. You got the other ones earlier, right?
Today?
Uh-huh.
What time did you send them?
Hold on. I sent that 9:33 a.m.
No, I didn't get that. The only email I got today was from Miguel for the new link.
Oh, okay. Okay, let me see if I can send you all of those one time then.
Thank you.
Okay, hold on now. What is it doing? I was just getting ready to put your thing in here. What did it do? Okay. Let me just do it like this one. Okay. The other class members could start to read it. It covers a point that was raised by Ellsworth in the last class. I haven't finished reading it yet, but let me send this to Keisha.
Ms. Archer, what are we reading, please?
The case I just sent.
Just sent. Okay, thank you.
One I just sent. I'm trying to send these to Keisha now because she is missing all of them. Okay, let me start putting these together for you. So it's this one. I have to look for these cases and you all are always so excited. Ellsworth, you probably would like this one.
Good afternoon, my friend. Teacher, how are you?
I am fine. I found this case a few minutes ago, Bank of the Bahamas and not Bank of the Bahamas. Is it Bank? Yeah, Bank of Bahamas and not Bank of the Bahamas. Which one that is? Yeah, Bank of the Bahamas. I'm gonna start what?
Oh, Jesus, I need a pen.
That's the last one I sent.
Okay. Jesus Christ. Yes.
Lawson. Whoa.
You said you just sent it to us, Mrs. Archer?
Yeah, just now.
Okay, I don't see it as yet.
What you mean?
I don't know why, but I don't see it.
I sent it. Hold on, let me finish her, and then I may have to add you on here. This person was Gibson. Yep. Gibson. This one here. And what other case I have here? All. Gibson. Rosita Johnson. Let's see. Okay, let me go back to my list. How come you don't have it? You have another email?
Are you
I sent-
referring to me?
Yeah, SMICHEL@BM.
Yeah, BMC Homes with an
Yeah.
S, HOMES.com.
But you got it before, right?
Yeah, I mean, there were times at the beginning where it didn't go through.
Okay, I'm sending it again. Tell me if you have it.
Okay.
Okay, Sheila, you should have it too. I just sent it again.
Thank you, I have it.
Good.
You said we're reading the case with Scotiabank and Ricardo Gibson?
No, Bank of the Bahamas and Mark Oscar Gibson.
Okay, thank you.
Okay,
I have it now.
okay, good.
Hi, good afternoon, ma'am. How are you?
I'm fine.
Okay.
Reading it.
Yeah, which case are we supposed to be reading, ma'am?
Bank of the Bahamas and Mark Gibson. Mark
Thank you very
Oscar.
much.
Okay,
I appreciate it. Thank you.
okay.
Good afternoon, everyone. I wasn't hearing anything. Are we supposed to be
Oh,
reading a?
we're reading Bank of the Bahamas and Mark Oscar Gibson.
Thank you, Mrs. Archer.
That's the last case that I sent.
Perfect. Thank you.
Good night, everyone.
Good night, Tony. We're reading the case of Mark Gibson.
Hello, good evening, everyone. Miss Archer, I was able to make it. So which one is that again we're reading?
Ms. Archer, can you hear me?
Yes, Bank of the Bahamas and Oscar Gibson. The last case I sent.
Would you send today or yesterday?
Oh, today.
What time was that?
A few minutes ago, but 1 minute before class began.
Oh, I didn't see that. Are you able to send it to nekielm@gmail.com, please?
Hold on, you riddling too fast.
Sorry.
I have to find paper first. Where you want me to send it?
nekielm@gmail.com.
NEKIE.
LM@gmail.com.
Okay.
All right, thank you.
Okay, hold on. Let me know when you get it. I'm about to send it to you. Forward it. I sent to these here. Okay. NEKIEL.
Yes, ma'am.
Gmail. It's very short, so we should be.
Ms. Archer, can you hear me?
Tony, you should have it. Well, I sent it to.
Oh, I have it.
Okay.
I have it. I am still at work. I'm leaving.
Oh, okay.
Yeah, I just got out of a meeting, so I am on my way home. I should be home within the next 10 to 15 minutes. I can hear you and listen to you, but I haven't read.
Okay. All right. That's fine.
You just gave us.
I received it, Miss Archer.
Okay, good.
See you, thanks.
Couple of pages. Anyone finished reading it as yet? Almost done? Okay, we finished? Almost?
I'm finished.
Okay, all right, and everybody's finished?
Finished.
Not
Finished.
that long, pages. Okay, so let's start. When we began the course, we looked at what is land law in general, in particular to the Bahamas and having unregistered land. Then we move into understanding the conveyancing process. We then looked at different types of mortgages, the law relating to mortgages. And now today and Wednesday, we're gonna look at the mortgagors and the mortgagee's duties and liabilities. So if we start with the mortgagor, we know that one of the principal obligation that the mortgagor has is to repay principal and interest and any other sums advanced by the mortgagee on demand. And we know that if he fails to pay the principal and the interest, the mortgagee has the right to pursue a number of legal remedies that we went through in the last class. The mortgagee, in most instances, would likely seek to exercise his statutory and contractual power of sale and sell the mortgage property in order for him to recoup whatever is outstanding, which we have seen in a lot of the cases that we have read and discussed. And that would also include any other funds that they have actually expensed for the mortgage property. It should note that the bank service charges owed to it also, all of that becomes a part of the outstanding amount. So it should be noted that the mortgagor is afforded some protection in law when they exercise their power of sale, or when the power of sale is exercised by the mortgagee, because the mortgagee has what you call a limited equitable duty to the mortgagor and any guarantor. And that is to take reasonable care to obtain the market value of the property at the date at which it decides to sell. And recall in the last class, the mortgagee decides when they are going to sell. So, notwithstanding this equitable duty, the mortgagee does have a duty to take any action does not have a duty to take any action to preserve the value of the security in the exercise of the security rights. And that's why you would have seen a few years back, about 3, 6, 9, 10 years back, when the bank started to apply to the court for vacant possession and then to exercise the power of sale, a lot of the borrowers decided to go into the homes and start to take out the cabinets, take out the tubs, take out the fixtures out of the building and start to demolish the building before the banks actually were able to get vacant possession. So in the exercise of its power of sale, the mortgagee is permitted to exercise such power even though the mortgagor may have already agreed to a sale, which would provide sufficient proceeds to pay the whole amount of the mortgage debt. The mortgagee may be prevented from selling the mortgage property under the power of sale if the mortgagor has tendered the whole sum before the sale. So even in exercising a statutory and contractual power of sale, and remember when we say contractual power of sale, the power of sale is actually a clause written within the mortgage deed. A mortgagee is not permitted to sell the mortgage property to itself, as this would amount to a foreclosure. And you know that a lot of the banks now do not want to sell mortgage properties to themselves because they don't want these assets on the books. According to the Homeowners Protection Act, the mortgagee shall not sell the mortgage property to any of the following parties. And remember, we discussed this last class also. They cannot sell to the director or an employee of the financial institution as they used to do in the past. They cannot sell to any immediate family member of a director or employee, any company that is beneficially owned by a director or employee, or any person who by the nature of their intimate relationship with a director or an employee of the institution would be given favorable consideration, because all of that is to sum it up in 3 words, is a conflict of interest. So once the mortgagee has sold the mortgage property under power of sale, it is a trustee of the proceeds. And to avoid a breach of trust action, they have to pay the proceeds as follows. any prior encumbrances, the cost of the sale, any monies payable under the mortgage agreement, any subsequent mortgagee, and of course, whatever's left to the mortgagor. So let's look at our case now with Mr. Gibson, who is challenging the Bank of the Bahamas, saying that he does not owe them any money. Who wants to chime in first? Kristen, you want to start? Okay, Shala, you want to start?
My only concern is how he was claimed to be under the assumption that he can start paying his mortgage 5 months later.
I don't know. Because I don't see in here anywhere, I don't see how he came to that conclusion. Because if we start from paragraph 1,
Mhm.
his new loan, according to his commitment letter, brought his indebtedness to $307,000.
Mhm.
And he had 2 loans requiring 2 separate payments. The bank then, in 2009, less than three years, two and a half years later, decided to restructure his loans.
Mhm.
And in the commitment letter, dated the 26th of May, it reflected the economic circumstances under which restructuring was done.
Mhm.
So the restructured loan reflected a balance or sum of $305,000, which was to be repaid over a 20-year period and mature on May 30th, 2029. And as the judge said, it could not mature on May 30th if you're starting it 5 months later. Mathematically, it does not compute. Your contract says that your loan matures on May 30th, 2029. So how did he arrive at that assumption that he had these 3 months? That's the question I don't understand. Because then he comes back and he says in which paragraph was that? Paragraph 8. Gibson says he relies on an entry in his accounts of the bank, which is identified as principal disbursal. But he didn't have a principal disbursal in cash, because what they actually did is they did a restructuring. And of course, in the restructuring, principal actually would be changed, but he had not received any additional funds. He said last disbursement made by the bank under the loan facility was made on the 4th of September 2009. But that cannot be right, because when he had the whole loan itself restructured, the loan was restructured in May 2009. So he couldn't have had 2 restructuring, and he didn't have a disbursement because he didn't receive any cash. Monique, what you have to say? But Mr. Gibson.
It could be a case scenario by Mr. Gibson misunderstood what was taking place, and it was probably not properly explained to him. Like when we come to the part of the restructure, I know that they pay the outstanding interest, and they probably had to say to him, this was the interest that had accrued for the period of 3 to 5 months. And in his mind, he probably was thinking the loan was paid for that time frame. I mean, that's how I'm looking at it. But two, I think he was quite aware of what was going on. And he was just trying to see how he could, come up with an argument to
Mhm.
win the case.
But how? When he admitted
But
he hadn't paid anything from 2016.
I
You
like
don't-
I say, I guess when anything the restructure took place, that this covered everything that that happened in the past, that he started off fresh.
Okay, so he says in paragraph, okay, let's go to paragraph 5.
Mhm.
Paragraph 5, he says he relied on the affidavit of Mr. Maycock, a licensed accountant,
Mhm.
who himself, his report doesn't make any sense.
That's why I'm all confused.
Because if he is an accountant, like we know, because it says in 9, Gibson relied on the provision and assessment made by Maycock that he was not in arrears of the loan. But if the loan commenced in May, how could he not be in arrears?
Or two, it can be a case scenario, because I think I see something where he said that monies was on his account.
No, you
Okay.
mean when he said principal dispersal?
Yeah, so in this man, yes, I'm thinking he could
He's
get
looking at the
these.
wording.
Yeah, so that's what I'm saying. He could get that mixed up, and it wasn't properly explained to him exactly
Yeah,
what it is that was going on.
but that's Gibson. We're talking now about the accountant who prepared this assessment for him. If I paid my money to you as an accountant to assess my loan and determine whether or not I am in arrears or not.
I
If
mean,
the
I
account- I don't
think he was really an accountant, because if he had all of the information.
Yes, he is.
Yes, really?
Yeah.
Because I mean, I know we give commitment letter, and if you have these documentation, so you should be able to come to the court and your information should reflect with the banker.
Yes, paragraph 5 say he sent it to an accountant.
Mhm. Yeah, I see that.
Yes. And what the accountant is, he qualified his assessment of the state of the loan as not satisfying internationally recognized standards. And then he put in his assessment that the payments were to commence on the 30th of October and not May 30th. Where in the world would he get October from? Because he took the same wording as saying principal dispersal. But as an accountant, he should know that if you restructure a loan, there is no principal disbursed.
No, there's no funds to be dispersed.
None whatsoever. And I'm sure Mr. Gibson knew he got no funds. So he himself, the bank says that Gibson didn't pay sufficient funds to satisfy his payments on October 2009, January to March 2010, August 2010, October to December 2010, May 11th, August 11th, and then he said he hasn't paid it since 2016.
Yep.
I think they just let this carry on too long.
Perhaps.
From 2011, that was it.
Some banks just be very lenient.
No, oh, very lenient and you get nothing.
Yep.
No, but there's a time you stop. Because when you look at the mortgagors, is one of this primary obligation is to pay. And so in all of these periods, he could not pay. After he was restructured, this should have been stopped.
True, that is so true after the restructuring stage.
Yeah, after you restructure, and after the restructuring, if you cannot make the payments, then that's it.
Mhm.
was from 2011 to 2016, 5 years. This was not paid.
But normally what we do, before we do a restructure, we'd have the clients either pay 3 or to 5 month consistently payment before we restructure loan. You know, just to see and to think that this is something that they really want to do and they can handle it.
Yeah, I know that that's the normal practice. And then if for whatever reason he loses his job or his spouse loses his job, then you sit down and you look again and see, can you do a further restructuring if necessary?
Yes, ma'am.
But here, to me, the mortgagee is at fault. Not saying that not saying that they cannot go and put in and say that we want vacant possession and want the property. I'm not talking about that right to do that. I'm just saying this process here was too long. This is too long. You're talking about from 2009 to 2020. That's too long.
Yeah. 11 years.
11 years. They pursuing this man to make a loan payment of over $3,000 that he could not afford. And that's what the judge is saying in essence. You're just calculating it and just looking at your maturity date. Whenever anyone gets a loan, the first thing you look at is monthly payment, maturity date. Okay, how many payments is that? And you start counting down. But I do not understand how he could fathom that at the end of the day, after this decision was made, he actually went to the Court of Appeal. And he appealed this decision, saying that the bank was in breach of its contract. And because the bank was in breach, he's saying that the whole contract was null and void and invalid. That I don't understand. If you know you have an obligation to pay and you did not pay for years. And of course, you know, that was dismissed. He wanted to go to the Privy Council and all. And that was dismissed. Again, even though the bank has that right to exercise its power of sale and also request a vacant possession, you could see in a lot of these instances, by the time they go to court, I think that the banks have been overly lenient in terms of trying to recoup the funds that have been borrowed. Anybody else have any comments? Brianne, what about you?
Hi, Ms. Archer. Mr. Gibson sounds like he's a bit mental. I don't understand how he doesn't understand that he was in breach of his primary obligation to repay this loan. And the technicality, what he trying to, his little misunderstanding, it's so flimsy. And if he wants to advance some argument, he needs to sue his accountant. That's the only person who I think he has a grievance against.
Mm-hmm. Because the accountant should have actually worked from a copy of his mortgage deed. The commitment letter, that's all he needed. This is what he agreed to.
All right,
Mr.
so had the
Gibson had
accountant
been-
not led him astray, he might not have been so confident that, you know, that he's not at fault and that he had a leg to stand on.
I don't think Mr. Gibson had a leg to stand on because he had already had a previous loan. So he couldn't pretend even that he didn't quite understand. If he was a complete newbie and it was his first loan, then, maybe someone could argue the fact that he may not have clearly understood what he was doing or what he was getting himself into.
Mm-hmm, mm-hmm. And these
Agreed.
people are borrowing small sums of money. They're borrowing large sums of money, which they don't qualify for.
Well, Mr. Gibson had a long run.
No, that is
It
too
is
long.
not a- Yeah, it really dragged on too long.
I'm curious as to why they had two separate payments and why they didn't just restructure the whole thing from the beginning and just create one big, lump sum balance and let him pay one payment every month so that he would be clear on everything that was going on from jump.
Yeah, just rewrite the whole thing in one. Probably confused, but I don't think he's confused. I don't think he's confused. He's just trying to get out of not paying this.
Yeah, I was just gonna say he isn't confused, but that's part of his case. So he is playing the part very well.
Yeah, he's playing the part very well because he admits to not having paid anything on the loan since 2016. You borrowed $300,000 from a bank and you have not, and you admit you haven't paid for it, but still you're saying that the bank breaches contract. I don't understand.
Maybe I just love how you just don't understand, Miss Archer. Maybe you should spend a week by us and I could bring you could see 50 or 100 cases like this every day. So I'm not even surprised at how he's acting because on a daily basis, clients come in and they get the loan and then when it's time to pay, they're like, but I didn't know, no one told me that. No one told me that.
Let me ask you a question. In your company, when you do restructuring, at the end
Right.
of the week, I think, yeah, it was weekly. At the end of the week, do you all sit down and rationalize in front of, not necessarily a panel, but with independent persons from other departments, going through each one of those cases to see whether or not they actually really qualify for a restructuring?
No.
Oh, you see, first,
So I understand what be when you said Bank of the Bahamas, I was like, well, you know what? Let me don't say anything.
no, but no, not to say anything. But the point is that the whole point is you're here to learn and to share.
Right.
And you could see, just looking at the cases from this institution itself, there's a lot of checks and balances not in place.
Right. And because their organization is made up different, like they don't run like Bank of the Bahamas and Bahamas Mortgage, they don't run like the typical commercial bank like RBC and the other ladies in here. Maybe they could attest like how.
Yeah, but hold on.
like
When you say
that's
run,
money
like, no, hold on.
from
When you say
RBC,
don't run the other typical, that
right?
cannot be right because they're all banks.
Right,
all
I
bank
understand that,
controls.
but they do. But some are governed by different policies. Like they could, okay, like how Monique said that. I know, like when you go to like RBC or Finco, I mean, or what's the bank called? What I bank with? First Caribbean. You know, if you had to restructure a loan, like she said, they would make sure that you're able to pay those payments before they decide that they would restructure the loan. With us, once you fall on hard time, they don't give you, you don't have to prove that you could pay over like a 3 month, like for 3 months straight.
That's untrue, actually. It's a 6-month period by us. They have
But
they have to pay consecutively. The collections department ensures that they have to pay at least 6 months completely and on time and everything and fully before they would even consider
That sounds good,
restructuring.
Michelle, but I have watched them do it for other persons where that's not true. So it depends.
On what?
I don't know who the person is. Let me mute my mic.
No. Now you see why this whole area of mortgages gets really complicated and difficult. Because in banking, the practices supposed to be the same. Your policies and procedure follow certain rules. Now, when we had the trend where a lot of people we had the economic downturn and a lot of people started to be laid off, they started working days. These bankers sit around the table and they have a discussion. They sit around the table and they also discuss what their final decision is and the steps that they're going to take. So nothing is secret from each bank. You have the domestic and then you have the Canadians. So even if you don't want to send an email or you don't want to call someone on the phone, there is a forum where they discuss what they're going to do, how they're going to do it, where they're having difficulties. And what is so amazing is that when you read these cases, there's just so many gaps of internal controls. And then you look at it, like you're saying, even the policies. The policy is the policy. And when there are exceptions, exception has to go to a committee. And it has to be documented. So that someone else who comes for an exception has to fall within that criteria. So what I don't understand is how this man. Okay, what you have to say? Hello? Someone was about to say something. I don't understand how he was allowed to operate this loan in this manner for so long. I don't understand. But this is hopefully a good example for this bank to look at their procedures when it comes to restructuring. Because something like this should never happen.
Hello.
Yes, go ahead, Elsewhere.
The only suggestion is their receivables section is not working properly, because normally these matters are sent to receivables, and sometimes they allow these matters because it's not that effective and it's not being driven. That's how they fall through the crack, and that's how this matter probably was allowed to linger for so long.
But okay, accounts are assigned managers, and the managers have to work these matters. So between 2011 and 2016, who was managing the account? That's where you start from. And I know that BOB has actually hired retirees from the Canadian banks to assist them in putting the proper structure in place, and also the system and the way in which things are done methodically and procedurally. And I don't understand how this happens. And then this again shows that in terms of the borrower, that the Bahamian people still don't understand their obligation when it comes to a mortgage. That their first obligation is to pay that mortgage. Not go on vacation, not play numbers, but to actually pay their mortgage. And I don't think they understand the gravity of that actual mortgage deed when they sign that, what those covenants mean. and their obligations. So under the mortgage itself, the mortgagor covenants to the mortgagee that he or she beneficially owns the property, and there is an implied promise by the mortgagor has the power to convey the property. And the mortgagor also covenants as the beneficial owner that the mortgagee is entitled to possession and that the mortgagor will execute further documents to perfect the mortgagee's title if required. And that they won't do anything that will prevent the mortgage from operating according to its terms. With a leasehold, the mortgagor also covenants as a beneficial owner or landlord that the lease is valid and that all obligations under the lease have been and will be performed. Now, the mortgagor also have, after repayment and ownership of the property being given to the mortgagee via covenant, there is insurance. And we know with insurance, I know from the Canadian banks, this was a huge project. Huge project. Because Bahamians do not like to insure their property. And most of them, when they insure it under the valuation of the property. So the mortgagor is required to insure the property and keep it in good repair and condition. And I told you all, I think it was the second class, how I've seen banks have actually repossessed home, asked for vacant possession, then put the house up for sale. And in between the vacant possession and the sale, they allowed the mortgagor to remain in the house. And they just run it right to the ground. Because as far as they're concerned, the bank is at fault, not them. So if the mortgagor defaults in this obligation, the mortgagee is permitted to do so. They can insure the property. However, the cost, as you know, is added to the debt. It also gives the bank the power to apply the insurance monies in repairing the property and or discharging the debt. The mortgage allows the bank to make payments of the insurance premiums upon which the mortgagor is liable without affecting his or her liability under security. So under the CLPA, a mortgagee, where a mortgage is made by deed, has the power to insure and keep insured against loss or damage by fire, any building or any effects of property of an insurable nature. Now, I know you all are aware from last year that there's a fault line coming through the Caribbean. Have the banks considered insurance to cover earthquakes? Monique? Anika?
I'm trying to remember if I saw any recent homeowners quotes, because we would have to get HOI quotes. I'm trying to remember if I saw any with the earthquake clause added into it. I just got a quote today. Let me take a look at it and see.
Yeah, because what's going to happen is this. Yes, we have it for fire, but what if there is an earthquake? how is the bank going to recoup its funds if the coverage is not adequate? And then what are the lessons learned from Hurricane Dorian?
Insure your property.
How often should the property be appraised to make sure it's not underinsured? Another lesson from Dorian.
Yes, another one.
But I don't see banks talking about the effects of Hurricane Dorian on his mortgage books. See, these are the things you see in other jurisdictions where the bank prints articles that is not only in their interest, but also in the interest of the client, especially when you're talking about mortgage properties. So here I am, my mortgage is 25 years, and I'm 15 years down the road, and then something like Hurricane Dorian comes. And I have my loan on my balance on the books is $250 because I built a nice mansion. But I have my insurance coverage now is based on maybe say $350, $375. And it doesn't include earthquake. What happens? How will the bank recoup its funds? What did you find in your insurance document? Seen anything is here?
Just have, hold on, I'm trying to see. Yeah, it just has fire and hurricane. So the basics,
Okay,
nothing
see,
in reference to earthquake.
right. So that's what the bank has to look at its portfolio in terms of coverage. Because remember now, if the mortgagor cannot pay it, then the bank pays it because you're protecting the assets. If you want to recoup your funds. And you know, the Bahamians always complain even now, just paying insurance for hurricane and fire. So the mortgagee, it has both a statutory and a contractual protection in the terms and condition of the indenture of mortgage, of its security interest for the mortgage of land. And that's through that power to insure. That's its protection. And I think banks don't give enough attention to that protection because it falls on both sides, the mortgagee and the mortgagor. If the mortgagor fails to pay the premium, then the mortgagee is given the power to pay it at the mortgagor's expense. And that's another thing that also needs to be brought to the attention when you are, now that you have the homeowners protection, is that when the bank pays insurance on behalf of the mortgagor, I think they need to know. And in this day of technology, a notice should go out to the mortgagor advising the bank has paid your insurance premium in the amount of so-and-so, which has been added to your debt. So at least can't say later down that they were not aware.
They still will say that.
Ms.
Or-
Archer, what are your thoughts?
Go ahead.
What are your thoughts on this situation? The mortgagee did exercise its right or its power to pay the insurance premium. The mortgagee rather exercised its right to pay the insurance premium because the mortgagor was in default. So they were paying the insurance premium good, and then some internal policy in the bank happened, and they decided that they were no longer going to pay the premium on commercial property. So they stopped paying the premium for this mortgager. The mortgager said they weren't notified that the bank had dropped the insurance. Hurricane come, the mortgage property sustains quite a bit of loss. Who do you think? Would you say that the mortgager is still the person that is liable to or should have kept the premises insured?
Well, even though that is one of the obligation of the mortgagor, I think the mortgagee themselves also, because you have that asset on the books and you want to recoup, should make sure that it is actually insured.
Right.
What is the rationale for not doing it?
Well, the bank's rationale was that they had taken an internal policy that this classification of property they were no longer going to pay the insurance premiums on.
But the insurance premium is added on to the mortgage.
Yes, it was being added on.
Too high?
No, the bank is just the explanation that the bank gave to the mortgager is that we made an internal decision that rental properties, you have a rental property, and we were no longer going to pay premiums for rental properties, only dwelling homes.
What did the indenture of mortgage state in the covenants?
Well, in the covenants, the mortgager is liable for keeping the premises insured.
It doesn't mention anything about the mortgagee in the event
No.
that the mortgagor doesn't pay?
I don't think so.
So,
but
if
in
you-
practice,
Go
the
ahead.
mortgagee had started to pay the insurance, and then they just abruptly changed the policy, and the mortgager is saying that they didn't know that the bank was no longer keeping the insurance current.
Yeah, because guess what? Even though that is an obligation, even though the mortgagor's obligation is to keep the property insured, because the bank, by practice, over the years, any borrower knows that if it happens, the bank will pick it up. So if you're going to change a policy, you need to advise your clients. That's only fair.
Agreed.
And again, I'm saying the banks are it's just a lot of loopholes, and the loophole is costing the bank on one side, and of course, by not informing the clients suffer in the end. But they should have informed them.
But here again is where the mortgagor is supposed to take responsibility for its indebtedness to the bank. We tend to try and throw everything on the bank. Well, the bank didn't do this, the bank didn't do that. It's not the responsibility of the bank to pay your insurance.
Correct.
One of the securities when you sign up for a mortgage, one of the securities that are supposed to be in place is HOI over the property for the duration of the mortgage. That's the responsibility of the mortgager. The bank will only step in if they see they don't get the information that they're supposed to get annually from the client to say that the insurance has been taken out. Now, albeit, yes, it's the bank's property until the client pays back every dime. And so if they see that the customer isn't paying it, then the bank should take the insurance out. But it's also the responsibility for the client, if you're not able to pay it, and you're assuming that the bank is going to pay it, for you to follow with the bank and make sure that it's paid, because it's your responsibility to ensure that coverage is made annually and proof of that coverage is provided to the bank. This is where we have a fall down in this society where Bahamians like to go and borrow and don't live up to their responsibilities and their expectations. And then they want to turn around and throw everything on the bank. Oh, the bank didn't tell me this. Oh, the bank didn't tell me that. Just like you would have said last class. And one of the things that I say to my customers, especially when you've had a mortgage on the books for a while, you need to make sure that your mortgage is being paid. You need to make sure that every penny that you said you're putting on this loan is going to the loan. So you make yourself accountable and go to the bank and get your statements to show that, okay, my payments are going through to my loan. And that's what it is. We as Bahamians, we as people that walk in the bank and borrow the people's money, need to make sure that we make ourselves accountable for the things that we say we are going to do.
Agreed. But my only point I was making was that if the bank has been doing it, especially talking about commercial clients who probably have big properties, I would think that that account manager would have communicated something to the client. Even though it is the obligation, because at the end of the day, the bank has an asset on the books. And if something was to happen, even though you would say that it's the mortgagor now who has to pay them funds to recoup, if you had insurance, then you'll be able to recoup something. So it's like a balancing, like you're juggling. Anyone else have thoughts?
The other thing, I think in such circumstances like this, it goes to the efficiency also of the bank or its officers, because if you have, let's say for instance, you have a property now you have Bahama out east, right? Out west.
Mm-hmm.
Before Bahama went there, I remember a friend had a condominium, and when Bahama went there, the property value soared through the roof. And so here you have this asset that the bank actually owns, not the mortgagor, and it's soaring in value. And for instance, let's say the property burns down or whatever have you, or something happens, the bank stands to gain much more if there's this due diligence to ensure that the property is properly insured. I think the primary responsibility for ensuring the property is indeed, and in fact, the mortgagor. But in certain circumstances, the agent in the bank has that duty to be vigilant to ensure, because I never even thought about, I'm a lawyer, and I never even thought about, I had a mortgage for about 12 years now, to go and reevaluate my home in case something happens, because you want it to be repaired. To have it repaired, something happens. And then there's this whole thing now, if your home is considered to be undervalued, the bank would then pay you, but not, I think, help me if I'm wrong. If you don't insure your property to the proper value, you can't expect the bank to come and assist you if you only insure it for $200,000. So yeah, the primary responsibility is that of the mortgagor, but there's an asset that the bank owns, which inures to the benefit of shareholders. And so if you have agents in the bank, I think and you have, and they're not, and they're not doing their due diligence, this is where the bank should have checks and balances to ensure that its managers are really functioning to their optimum to protect its assets.
Yeah. Because remember, at the end of the day, everything is the bottom line. So when you look, if there is a disaster, and then you look at your assets on the books, and there is no insurance coverage, and the persons are not working, how is the bank going to recoup its funds? That's why I say it's a juggling thing. You have to make a decision. So is this policy, the policy going forward, it was only for during that economic recession or the pandemic? Or this is just straight across, this is the policy?
Well, I'll say to you that in instances like that, because I worked for First Caribbean for 20 years. And I was in an area where we did a lot of, you don't pay your insurance, we can pay it for you. And
Yeah.
so like after a 3-year period, if the appraisal on the books was 3 years or older,
Yeah, you have to get a
we
new
would
one.
send for a new appraisal, and you're gonna cover that cost. So that gets added to your mortgage, just as the insurance premium is going to get added. But again, I put this back on the mortgager, because all of this is built into your commitment letter. And all of this, this is things that we, as if we're gonna go and we're gonna get a home, this is things that we need to take into account. Over time, the value of the property is going to change. So why not after about 3 years, 5 years, I shouldn't go and get my property reevaluated so that I can make sure that I have it insured for the correct amount? Because if you're going to pay insurance, you want to know that if you have to use the insurance, if you have to go and make that claim, that you're going to be getting what you need to bring your building back to the state that it was, or to take it to a better place. And so getting a building in 2000 and having it evaluated at one thing, and it's 2020 and you now claim insurance, I can guarantee you that building is undervalued. And so again, like I said, put it back on the mortgage, and we have to take responsibility and be accountable for these things. So Mr. Johnson, I will say to you, go and get your house evaluated, sir, and take the appraisal to the insurance company so that you can make sure you covered.
I agree.
I'm gonna do just that, and I'm happy that I'm in this course. I think, and I agree with you, but where is the primary responsibility of the mortgage? If there's an asset that's really, the legal title is with the bank, the mortgagee, and I think the officers in the bank has a fiduciary responsibility to ensure that the asset that they own, because I'm in this house, I don't really own this house.
No.
And so if I fall down, if I'm negligent in not going to have it properly assessed, then there's the duty, like you said, in your bank. Very good, where you say after 3 years, you will do that assessment. That was put in place because they probably had an experience where they had assets that they own. Because at the end of the day, if I'm a shareholder and I'm seeing that the bank is not, and you know, that was the argument, and I'll say this because I know this is a class for the Bank of the Bahamas, when lawyers and even judges saw how the Bank of the Bahamas was run, right? And this is the suggestion was made. Say, who are the managers? They have a fiduciary responsibility to protect the interests of the bank and the shareholders. What were they doing when this bank was slipping? And so even in terms of the assets being the property, even if the mortgagee, I mean, the mortgager falls down and let's say I don't go and do this. At the end of the day, if I'm a shareholder and I see, wow, this Ellsworth Johnson house is now next door to Bahamas, and a house that was once 500,000 is now 5 million. And because you weren't doing your due diligence, I lost as a shareholder an extra, say 50,000. There's an action that I may have against the bank.
Mm-hmm.
And what you see happening in First Caribbean and those other banks is because in other parts of the world, when these things happen, shareholders step forward. As a matter of fact, managers are sent to prison when they cause these type of losses. Thanks.
Yeah, yeah, you're right, Elsewhere. But then, like I was saying again, because these things are happening, no one is sitting back and trying to say, okay, what did we do wrong? Especially after these matters go to court. What did we do wrong? Because I'm sure the legal department get copies of these judgments. So why aren't they sitting back and making corrections to their policies and procedures and rethinking? Because what Elsewhere is saying is that when we look at it now, we're looking at the indenture of mortgage, the mortgagor, the mortgagee, and their obligations. But what he's saying is that's at that level. But when that board sits around the table, they're not looking at the mortgagor didn't insure, or the bank said that's the mortgagor's obligation. No, they didn't do it. They're looking at the assets of the book. How much is it going to cost the bank to carry that asset insurance? Because it affects the actual holders' value.
Your house, because the insurance is based on the replacement value of your home. Property, we don't insure a property and just the building.
Mm-hmm. Yeah, you're correct.
Mrs. Archer,
Yes.
I know with us, we offer a blanket homeowner insurance to all of our clients. And the reason we do that is to ensure that the homes are insured, and there's no, lapsing or whatnot, but it does take a lot of managing of that process in order to do that. But I'm concerned with the fact that if I, as a client, I'm shopping around looking for a financial institution to, apply for a mortgage at. The fact that with Bank A, I may be able to rely upon them to offer me, a very inexpensive home. I know year, or if I don't, they're gonna then apply it to the principal balance of my mortgage, right?
Mm-hmm.
Now, if a bank starts out offering you that and you take that into consideration, you say, okay, this seems reasonable to me, I'm gonna go with this. And then they change in midstream and all of a sudden they decide, oh, policy change here, we're not gonna do it anymore. I don't think it's really fair, because if you sign your contract with that understanding in mind and agreeing to it, it kind of alters the situation for the client. Maybe not for the banking institution, but is that reasonable to do that when you set that out with an understanding at inception?
Yeah, but that's what I was saying. When the bank changes its policy and it affects the borrower in terms of expending more funds, even though in the mortgage it says that the mortgagor has this obligation. So, but the mortgagor expects, based upon what you've been doing all along, that you will continue doing it, and so it's not budgeted. Now you decided you're stopping it. It's a whole reevaluation of how they're going to disburse their funds. And then sometimes, because now the borrower has to try and find that insurance money, you find out sometimes they're going to go in default because they're trying to save that money or they're trying to borrow from somewhere else in order to pay that insurance premium because the insurance is high. Those premiums are very high. So it's just some food for thought for you all to think about when you sit around the table and you're looking at mortgages and you're looking at the assets and you're thinking about insurance and the things that can possibly happen. And what will the bank do? Now, maintenance and upkeep of the mortgage property. The mortgagor is also required to pay all rates, assessments, stamp duty, charges, and real property taxes applicable to and affecting the mortgage property. And that includes utilities, taxes, and other charges. Now, I know that they are still trying to collect real property tax. And I know when they had the amendment to the Real Property Act in terms of mortgagors, the mortgagee, making sure that the mortgagor pays all the real property tax, there's a lot of pushback. Because the banks felt that, hold on now, the government believed we're supposed to be collecting tax for them. Because I know in some banks, they started doing a project first with commercial loans. And going through each one of those files to confirm whether or not real property tax was paid. If not paid, what is outstanding, and then whether or not it could be added on to the loan if the bank paid. So again, what's your take on that one? Maintenance and upkeep of the mortgage property. Because there are still a lot of real property tax outstanding.
Yes,
Yes,
there
Monica.
is. There is.
Mhm.
Like you said, yeah, the government has put it on the lending institution to assist them with collecting outstanding real property tax. But the only way we can, like mortgages that were already on the books, the only way we can recoup, like say for instance, if they come in for a further charge, that's when we would then be asked them to bring in the real property tax report, and when that is presented, or next case scenario will be like when they paid their mortgage off in full, and you
Mhm.
have to provide the real property tax report showing a zero balance before we can do the satisfaction of mortgage for them.
Yeah, but because I know based on a project that I did, by the time we were finished with the commercial loans and the amount of real property taxes was outstanding, it was in the millions. And that included properties that were up for sale. Or properties where you've had foreigners who would have borrowed funds and then just dropped the projects and just left. And you always have to be mindful that as the mortgagor, you have to upkeep the property. That's painting, replacing. It has to, the property has to appreciate in value and not devalue. And of course, as a mortgagor, you have an obligation to inform the bank if there are any encumbrances or encroachments or nuisance or disputes, or if someone comes around and it's from Ministry of Works to say they're doing some rezoning, you have to inform the bank. Again, because the property is mortgaged. And that is the security that the bank is holding, and the bank has an interest in that property. So even if you're in the house and you decide you have a mortgage, but you have a buyer and you want to sell it, you have to seek the bank's prior approval to do so. So last week we looked at the Homeowners Protection Act. I want you to look, I don't know if you had a chance to read the case of RBC and the Halls, Lawson Hall and Rhonda Hall. This is also short. You had a chance to read that one? Nobody?
No, ma'am.
Boy, what I could do with you all? So I'm supposed to be eager and excited.
You know,
Okay,
I did read it, but no, I can't remember what it was about. Jog my memory.
let me start first with the rights of the mortgagor. So
Oh, I remember now. They
you
did
remember?
not give the halls notice. They sent it through general mail, and the halls were able to rely. I think it was Section 4 of the Homeowners Protection Act that they
Yeah.
did not get their 30 days notice before the action was initiated.
Mm-hmm. Because the bank sent the wife's notice with the
Through
incorrect
general
address.
delivery.
Yes. When they were ready to go to court, they knew the exact address to put on the documents.
Yes, and it was prominently placed, and it was the same law firm who sent the notice that initiated the action. So they obviously were privy to their proper address.
Uh-huh. So now we move from the accountant making mistakes now to the law firm making mistakes. So the Homeowners Protection Act has three main features. The obligation of the mortgagee to give notice prior to instituting any proceedings. And that's what happened in the Hall's case. Or their non-judicial power of sale. The second features it, the right of the mortgagor to apply to the court for relief. And thirdly, the power of the court to grant relief to the mortgagor. The fourth feature relates to the long-standing, enduring nature of judgments. Under Section 23 of the Act, it says, no mortgagee shall recover from any mortgagor any sum owing under any judgment by the court for the repayment of any sums owed by the mortgagor from the mortgagor after the expiry of 6 years. I think a lot will not be paid. 6 years goes very quickly. And they say that this is a significant triumph for mortgagors who will no longer be saddled with an outstanding judgment hanging over their heads forever. So my question to you all is now, since the act came into being, that's 17, 18, 19, 20, 21. So this is 4 years. How many judgments do you have that are still out there, not acted upon, since 2017? Has anyone done an assessment of that in your bank? But so you can see from the cases we've read where the banks were granted vacant possession and they could exercise their power of sale and the person is still sitting in the house because they're going through the judicial system. So after 2017, there's 6 years. And after that, that's it. how will that impact the banks? Because there are penalties and there are breaches. Because it says it's equally a hard pill to swallow for lending institutions who either suffer losses when shortfall in such sales occur, or where they cannot dispose of properties due to depressed economic conditions. And that's why you see the banks did those wholesale packaging of distressed properties. So whenever the mortgagor is in breach of the mortgage agreement, Section 4, subsection 1 outlines the specifics that must be included in writing to the mortgagor prior to the mortgagee instituting legal proceedings. And the notice must be served personally or by registered post upon the mortgagor at least 30 days prior to instituting the proceedings. Upon receiving the notice, the mortgagor or member of the family who has been contributing payment prior to the breach can apply to the court for relief. So let me ask you, if you have someone who is contributing towards the payment, what evidence do you need to prove that they were paying towards the mortgage?
A
Let's say it's
salary deduction would be good.
Hmm?
A salary deduction would be good.
But can they get a salary deduction for a mortgage that's not in their name?
No, they can't.
Okay.
Yes, you can.
You-
You can, an individual can assign a deduction to someone else.
What does the document say? What does that document say?
What document are you referring to?
I'm not on the mortgage and I have a loan deduction from my salary to pay a part of that mortgage.
The
The
bank would just
document-
give you a deduction, the bank would give you a deduction letter. Now, whatever agreement you enter into with the bank would be a new commitment letter. But yes, you can assign a deduction from someone else's salary to facilitate payment to a mortgage that they're not on.
Why wouldn't you make them a guarantor instead?
Well, I guess that's an agreement that the bank would have to come into with the individual. It all depends on what agreement was made, but like I said, if someone wants to, like, in instances, I've had husbands that weren't on mortgages with wives. Like, I came into a marriage with someone that already had a mortgage, and something happened and they needed some assistance and the bank wanted to restructure. And I, as the good husband that I am, went and say, okay, I will allow you to take a portion of my salary by deduction, and you just sign off on the deduction letter, take it into your employer, and it comes to the bank. It happens.
It happens
The
with
sad
parents.
thing is, if they do it, they lock themselves in.
It happens
Most
with parents too, who fall into like arrears situations, and then they have, like, children who are working.
Exactly.
And then the child may step up and say, well, I have this job at a reliable employer. I can do a salary deduction to make sure that the mortgage is paid so it doesn't fall into arrears.
Mm-hmm.
And that usually happens when it's a restructuring going on.
Okay, I see. I'm just thinking on the side for this family member who has paid money. And then the person writes a will. And is not devised to them. Then they want to sue for what they have paid on the loan. Oh, it's messy. That's a messy one. So the court could consider the request if the family member wants to apply to the court for relief. And within 6 months, if they're able to pay principal and interest. Remember in the first case, how much time did the man ask for? Not 6 months, Mr. Gibson. Then he asked for 240 days. So he wanted 240 days to pay. To remedy a default consisting of a breach or pay arrears. So the court may, for a period up to 6 months, adjourn the proceedings or give a judgment or make an order for delivery of possession of the mortgage property. And or at any time before the execution of the judgment or order, either suspend the execution of the judgment. So where a mortgagor is in breach of the mortgage agreement, Section 7(2) of the Act, specifics that must be included in writing to the mortgagor prior to the mortgagee exercising his power of sale. And again, the notice must be served personally or by registered post. Upon receiving the notice, the mortgagor, or again, a member of the family who's been contributing to paying the mortgage, may within 28 days of service apply to the court for relief to postpone the sale. The power of the court to grant relief in this instance is laid out in Section 9, and the court may make an order to postpone the sale of the mortgage property for a reasonable period where it appears that the mortgagor is likely to either pay any sums due under the mortgage, remedy a default, or pay arrears. And Section 4, 5, 6, 7, and 8, and 9 do not apply to any legal proceedings that existed before the Homeowners Protection Act came into force. Now, there are other rights and entitlements under the Homeowners Protection Act for the mortgagor. Discharge from all liabilities for sums due at the date of sale. The mortgagor's liability for any residual sums owing at the date of the sale of the mortgage property may be eliminated. And the mortgagee's right to pursue an action for the debt may be jeopardized, given the provisions of Section 11(8) of the Act, which states that, save for any surplus amounts referred to in subsection 7, the exercise by the power of sale shall discharge the mortgagor from any and all liabilities for any sums due under the mortgage if, at the date of the sale, a sum equal to at least 1/2 of the principal and accrued interest has been paid to the mortgagee, or the mortgagor has been in occupation of the dwelling house for a period not less than 50% of the original mortgage term. Have any of you seen the impact of that on the balance sheet? Because this is saying that if the house is valued at 250 and no, the balance on the loan is 250 and you're able to sell the home for 200, then they're saying here that the mortgagor is discharged. Under section 11, the mortgagor may make an offer to purchase the mortgage property at the market rate prior to the mortgagee accepting an offer to purchase the said property. The mortgagor has the right to request in writing a mortgage installment free of charge up to twice a year. And the mortgagee must respond within 30 days of receipt of the request. And failure to do so without a reasonable cause, any rights that it may have for the enforcement of the debt will be suspended until they have actually complied with the request for statements. The act also says that the mortgagor, at their own expense, they may retain and instruct an attorney chosen by them from a list of attorneys approved by the mortgagee. He may also select an appraiser of his own choice from a list provided by the mortgagee, containing at least 12 names of appraisers or assessors who have been approved by the relevant minister. The mortgagor may select an insurance broker registered under the Insurance Act. So where a mortgagor exercises his entitlement under section 17, and that is the right to transfer the mortgage loan to another lender, the mortgagee must assign or convey the debt to the new lender without requiring the mortgagor or the new lender to pay any costs associated therewith. Under section 18, if a mortgagee transfers, assigns, or sells the mortgage's debts, the mortgagee must advise the mortgagor in writing not less than 30 days before the effective date of the transfer, assignment, or sale. So if you recall when they had the bulk sale, which is about what, 4 years ago, a lot of the mortgagors complained because the company that purchased the bulk sale had already started to contact them and they didn't know that had happened. The notice must be served either personally or by registered post. And then it tells you what the notice should include: the effective date of the mortgage debt transfer, assignment, or sale, the name and address or contact number for both the current mortgagee and the transferee, assignee, or purchaser, a statement that the transfer of the mortgage debt does not adversely affect any terms or conditions of the mortgage agreement. The transferee, assignee, or purchaser must not vary the rate of interest applied to the mortgage debt with the effect that it is higher than the interest rate prior to the transfer, require the mortgagor to pay fees, administrative or otherwise, or charges with or arising from the purchase of the mortgage debt, or offer the mortgagor new payment terms that place the mortgage in a worse position than he would have been had his mortgage debt not being paid. So that's the homeowners protection and the rights of the mortgagors. So our class on Wednesday, we're gonna look at the mortgagees, duties, and liabilities as a bank itself. And then we'll also look at the case of Scotiabank and the Gibsons and Finco and Ms. Johnson. Any questions? Is my class awake?
No questions, Natasha.
We're
right.
here.
Earlier, y'all fall asleep. All right, so for next class, read those two cases and read module 6. If I find any other cases, I will send it. Okay?
Okay.
Ms. Archer,
Yes.
where can we find a recording of this class?
I thought Miguel sent an email.
I think
did.
he sent the first 2 or 3, if I'm not mistaken.
I'll tell him, I'll tell him to send the rest.
Okay, thank you.
I'll tell him.
Okay, thank you.
All right, not a problem. Send him a note tonight.
Okay.
Okay,
What
All
was
right.
the second case again, Ms. Archer?
You mean for Wednesday?
Yeah, you said Bank of Nova Scotia and the Gibsons, and what was the other one?
Finco and Teresita Johnson.
Okay, thank you.
Okay. And everybody should have those. And if I find any more, hopefully I'll send the right email addresses. All right. So have a good
Okay.
evening.
You
Good
too.
evening, everyone.
Okay.
Good evening.
Good night.
Good evening, all.
Good evening. Good evening, Ellsworth.
Good night.
Good night.